Hello, everyone. My guest today is Gary Saarenvirta. He's the former head of IBM Canada's data mining and data warehousing practices and is passionate about AI and its ability to transform how retailers grow their businesses and establish an edge in an increasingly challenging and competitive environment. Under Gary's leadership, Daisy Intel, it's daisyintelligence.com, has established a track record for delivering verifiable financial outcomes for a rapidly growing list of global clients. Gary, you ready to take us to the top?
Absolutely.
So obvious question when we talk about anything retail is COVID good or bad for you?
I think in the short term it was bad. We had some, big pause on the sales button. So enterprise sales, big ACV. Our ACV is like 500,000 and up, and so sales slowed. A few retailers had trouble and paused services. So our kind of revenue this year was flat, slightly down compared to last year. But I think overall the market, our value proposition will be stronger post COVID as companies will look for more automation. It's going to be more competitive than ever. So having kind of pricing, better promotions, and being able to automate more of the work that human beings do. Retail merchants are overloaded with work. So I think given that e-commerce has gone up dramatically, so I think for us, I wouldn't wish it on anybody. I think in the long run, it's a good thing for us.
So how many enterprise accounts are you working with now today? I know last time you came on in April, you said you're working with about 25.
Yeah, we're still in the same number of banners. Like this year, as I said, has been flat. I think sales is now starting to come back. We expect to close, some counts for the balance of this in Q4 here, and then get back to the plan was to double in size this year, and we didn't do that just because of the COVID. I think really put a bit. It was like a big pause button.
So what was monthly recurring revenue last month?
Last month recurring revenue was $500K a month.
500. Okay. Yeah. So you're flat to like a slight decline. When you came back on in earlier this year, you said you were doing about 600,000 a month.
Yeah. It was a slight decline with a few losses, customers that went out of business. Like we had a couple of customers really struggle. So
walk me through, you just told me pre-show that you went out and raised another round. How were you able to raise another round where you weren't getting crazy diluted considering the company had shrunk a bit?
Because our existing investors believe in the company. In Canada, there's government matching programs to help companies. We're in a hot space, AI. We're one of the fastest growing companies in Canada. Even though this year been a slight decline, we're still in the top 100 fastest growing companies. So between the space, the belief in our value proposition, our existing investors put some money in it, and the Canadian kind of government-backed VC funds put a couple. So we raised like $5 million a couple of weeks ago. So that's really extends our runway, for another 18 months.
Which $5 million total. That includes the government and the VC stuff.
Yeah.
Okay, so that means what total raised today is about 20 million.
Yeah, we've raised about 20 million in total.
Yeah, interesting. And is the money that the Canadian government puts in, are we talking like shred financing or no? They actually have a program that's equity.
It's a program, yeah, matching. It's like so this round was convertible debt, so it's nice. It's very good because it'll convert into the B round. We have 3 years to convert into it's a 3-year term and convertible into a B round. So they've been doing it with a lot of tech companies, who've been burning cash. VC backed really extends our runway. Given that sales is kind of been slow for the year, and just picking up now.
And what did you use as the cap on that convertible debt?
There was no cap on it, so it'll just be a discount to the next round. So
I see. And is that, typically on safes, we'll see like a 20% discount. Is that similar to what you got?
Yeah, it'll be about a 20% discount to the next round. And we expect to do a B round within 12 to 15 months. So the goal is, to cross the 10 million ARR threshold this year or next year. I think that's the plan. We feel the market coming back, a lot more sales activity in the last month. I think companies are realizing that the new normal is going to be, the old normal is never coming back, and everyone's come to grips with they got to get back to business. So feeling the momentum picking up again, actually significantly in the last 30 days. So,
did you change anything, Gary, about your burn? I mean, again, back in April, I think you told me you were burning about $500,000 a month in net burn. 65 people on the team. Did you have to trim anywhere to get more runway?
Yeah, we trimmed. I mean, we lowered burn. We let some people go. I think it was, an opportunity to, make sure we had the right people on the bus, throw us a bit of that, and then just, cut back burn to extend the runway. And, even though we raised money, we're still, making sure we have 18 months of runway. That's the worst case scenario. And so that's the plan we have in place. And so we're really being very very diligent on making sure whatever we spend generates ROI. So we're focused on spending on things that are sales, marketing, customer success. So new customers and keeping existing customers. That's the focus of the investment capital.
And so what's the total team size today?
The total team size today is like 55 today.
Okay. So down about 10 from pre-COVID or during COVID times. Yeah. And do you still have all 22 engineers, or did you let any engineers go?
The engineering team is still 22.
Got it. And quota carrying reps, is that where you trimmed?
We trimmed a little bit on, there's some reps. We trimmed a few sales reps. We trimmed because we also took this time to retrench, like a 6-month pause. We kind of, updated our sales process and our sales team and changing the way we go to market a little bit. So there's some changes in that. So there's a couple of direct sales positions that we eliminated, getting different kind of people involved in sales. So more of the senior leadership team being involved in sales, and trimmed a few client people and a few kind of general and administrative staff, really, trimmed the excess really, but didn't take away any staff that's directly contributing to customer sat or bringing new sales. I think that was the.
So how many quota carrying reps do you still have today then?
So today I'd say we have like 3 quota carrying reps, but the process now, but we've added, with the leadership team being more involved in sales, I'd say before our sales team was about 8 in total. Now it's like 11 in total, with a different mix of skills, right? So I think we sell enterprise software. The realization was that we're selling a partnership wrapped around a product, not just a product. And so getting the people who deliver to our customers more involved in selling, that's been the big change. And so that mix of quota carrying rep versus subject matter expert, that's where we really brought in more subject matter experts and gave them a role to participate in sales more.
So let's dive into the product here, because what you're doing is interesting. Now, from what I understand, your theory of retail product, which is for, retail solution, you're actually managing and looking at transaction data and sorting it in a way that these retailers can use AI to make better sort of product, and urgent decisions. Do you consider yourself sort of a fintech platform? Are you like Second Measure? You're reading statement descriptors?
Yeah, we deliver, the goal is net income growth. We do have an insurance fraud solution, which is more traditional fintech. So in the same way that we help retailers make smarter merchandising decisions, we help insurance companies with fraud detection and underwriting and claims automation. So our system says, what are the best operating decisions you can make to grow net income? That's really the deliverable. And although retail and insurance sound wildly different, at the core, it's, if I make this decision, what's going to happen? And these are the core decisions in retail. Merchandise planning is the core, kind of weekly promotions, prices, inventory allocations, and also, what to promote, what not to promote. That's an important mix. And then in insurance, it's underwriting, claims processing, fraud detection.
And Gary, sorry, your audio is sort of trailing off. Just make sure your microphone's plugged in nice and strong for me. In terms of the retail side of things, what data is the retailer feeding you so you can help them make better decisions around what to promote?
Yeah, we get their transaction log receipt. So literally every item and every transaction, bricks and mortar and e-commerce. So the goriest detail. I know every single item and every transaction for several years. And then around that is all what promotions they did, what were the prices they charged, all of the kind of operational details.
So obviously, once your consumer swipes a credit card in a Daisy Intelligence retail or outlet, that's sort of after the fact data. You then have to sort of use after the fact data to enable the retailer to make decisions before they have any real data to base that on, right? So how does analyzing data after the fact help you make the retailers make smarter decisions?
Well, because we have a mathematical theory that's independent of the data. It's like the laws of physics. If you had think of an autonomous race car, there's no historical data how to drive a lap around a racetrack. You're not building a predictive model. So you have the laws of physics and you say, okay, I can simulate the laws of physics. And then the historical data just kind of configures the simulation, like the gravity, wind resistance, friction of rubber on the road. So the same way we use the historical data to calculate cannibalization, halo sales, elasticity, and then we plug it into our laws of physics, which is this kind of theory of retail. And similarly, we have a theory of risk. So we're simulating the future, and you don't necessarily have to have ever done it in the past. It doesn't need a labeled example. So the historical data just lets us calculate seasonality and elasticity, cannibalization, halo, pull forward, and then we plug those into our laws of physics and then simulate the future to say what's the optimal decision set I can execute, even though you've never done it before.
Gravity is a law. You can't arbitrage gravity. No matter what it's going, things are coming back to the ground. So if what you're saying really is a mathematical rule, like a law, and you make the assumption that everyone starts using you, well, it can't work for everybody, because at some point consumers don't spend money across all the retailers using Daisy Intelligence. How do you account for this?
We're optimizing the market. Given an entire market, we're looking at all the competitors in the market as well. So it's optimizing a total company, and we've modeled the retail dynamics and insurance dynamics to saying if you do these things, and obviously, there's some assumptions like, the market is fixed. There's a $700 billion grocery market, and for the grocery industry, and given that the money is fixed, yes, it will shift between companies. Every dollar you grow is taken from somewhere. It's either customers not spending that at another competitor or at a restaurant or something else. So that's the dynamics we figured out. And it's not like, I wouldn't say it's like Einstein's theory of relativity. That's a very absolute provable laws. Ours are, they work to drive massive sales growth. I mean, we've grown our client total company revenue by 3 to 5%, which on a base of our largest customers, it's more than $1 billion in annual revenue. So it works good enough to generate that value. I would say it's not an absolute law, but it's pretty close because it works. We use the exact same math at every single customer.
Mm-hmm. I mean, if you're taking a company that's processing $1 billion in GMV and you're giving a 3 to 5% improvement, that's a $30 million to $50 million more revenue for them. They're only paying you $100,000 a year. $200,000 a year. I mean, if you're truly having that kind of impact, why aren't you making more money from them?
That's what we're struggling. It's the human change management, and getting them to say, yes, I agree with your analysis. They do 20 other things too, and retailers saying, well, what about the things I did? Didn't they have an impact? And so, it's this human change. And
isn't that always the fight though? Every vendor to that retailer is trying to have direct attribution so that you can charge more. That's the whole battle.
Yeah, and no retailer will ever admit to us that you did this, right? Like, because if they do that, it's negotiating leverage. So, I mean, we have a very solid mathematical calculation that's pretty strong, and then we're asking, say, hey, we'd like to measure all the other things you did too, so we can do attribution. We're happy. We're not saying that they're not doing nothing, and so we're figuring out how to tell the value attribution story. And I think once we're on the cusp of that, I think that will drive our growth more. We've been more of a challenger sales process in the past, and so we're stopping the challenger process and being more, hey, what you do is great. The world has changed. There's risk of change. Our software works in the new world, and you can keep doing what you're doing. And so retailers got to say, is the risk of staying the same more or less than the risk of changing? Mm-hmm. And so we're now, as opposed to saying we're really great and what you did was crappy, that was totally not a valid approach.
On the 11 quota carrying reps that you currently have, how do you decide what quota to give them? As folks scale to 10, 20 million in ARR, this is a constant battle. So what do you set your quota at?
Yeah, we set it at a number like 2 or 3 deals per person, right? So that's a number. We cover the total, the business plan by double, right? Figuring that the average.
Well, what's just the dollar though, Gary? I mean, what's the dollar? So it's $1 million a year quota, 2 million.
Yeah, it's like $1.5 million quota and then the team leader's got a team quota. That goes above that, right? So the plan next year is to grow revenue by more than 5 million in ARR, right? So. Right, we're going to grow it from 6 to 12, right? And so we have like 3 quota carrying reps and then our leadership team is like they're comped on the total company. It's not like they're carrying a sales.
Okay, so you don't have 11 quota carrying reps. You have 3 quota carrying reps.
3 quota carrying reps, and the leadership guys who are the 4 of us who get involved, or there's like 6 of us who get involved. We're more comped on the total company profitability, from our shareholders, right? So it's a different comp model.
You're still burning though to invest in growth, right? How much are you burning per month?
Absolutely. Yeah, we're burning today, we're about 300K a month, so we dialed it back from the 500.
Yeah.
5 million we raised, that gives us and we have some debt financing, from Espresso Capital, and we have a commercial bank.
Oh, tell me about that. How did that work?
We've had an Espresso Capital facility for several years. So we've got a $5 million facility that's shared between a commercial bank and Espresso Capital. So the sum of the two is 5 million based on multiples of MRR. And so we have access to another 3.5 million in that facility on top of the 5 we have, as long as we keep growing. So that gives us enough runway to burn on average 300K for the next 18 months.
How much is in the bank right now though?
Oh, we just did the 5 million, so we're pretty close to the 5 million.
Oh, so you actually pulled the full 5 million. That's 5 million in your bank equity. Yeah. On the Espresso line though, you haven't pulled the full 5 million line. You only pulled 2 million.
Yeah, we've only pulled what we've used and what we needed, so we've been kind of flat on that line for quite some time.
And for anyone else thinking about working with Espresso or just venture debt in general, what's the cost of that capital? How's it structured?
It's pretty expensive capital. I mean, it's like 15.25% interest, and there's no dilution. It's no equity. The Espresso guys they're fantastic. I've worked with them for several years. I mean, Al Karim and his team are great. It's expensive, but it serves a purpose, right? And if you want capital that's non-dilutive, you pay for what you need. They also do the shred. That's MRR plus shred kind of lending in Canada. So those two combined effects gives you your monthly multiple. And yeah, they're great.
Do they take warrants?
No, they don't take any warrants. So it's been great from that perspective.
And what about covenants? Obviously with any term loans, there's typically covenants. What's the worst one?
The covenants are like 40% year over year growth, right? So that one's tough in this COVID environment. And then there's total, net liquidity covenant, which we satisfy with since we raise capital. But there's a total net working capital covenant, which is a formula based on, cash in the bank plus receivables and all this kind of.
Well, so Gary, how do you deal with, how was the conversation with Espresso? You didn't grow 40% year over year, which means you would have broken that covenant. Do they call the $2 million line back immediately and you have to come up with the cash?
No, it was just for drawing new funds. You need to show so they wouldn't, but they've been flexible. So if we wanted to draw funds, they work with they're very flexible. They're not an aggressive lender. So they know that the only way they're going to get their money back is to make sure we succeed. So, when we needed to draw more money, if there's a covenant that we didn't meet, they took it to their credit committee and kind of case by case basis decided. So
smart.
They've been super patient and super supportive lenders.
And using strategic debt to preserve your own equity, what's that enabled you to do in terms of preserving your equity position in the company? How much do you still own today? Yeah,
I own the 27% of the company, which is still great. I mean, it'll be diluted in the next round it's helped me not dilute by.
Do you have co-founders or do investors own the other 70%?
Sole founder, yeah.
So investors own 70%. Yeah. Interesting. Very cool. All right, Gary, let's wrap up here with the famous 5. Number 1, favorite business book.
Favorite business book these days are The 5 Dysfunctions of CEO by Patrick Lencioni. I've been reading that one. That's a good. He's got a whole series of books. I like those.
Number 2, is there a CEO you're following or studying?
I can't say not really. I mean, I look at the whole world. I mean, I've read Elon Musk. I've been more impressed by him after reading his book than I was before. I thought he was a bit of a nutcase, but after reading his book, he's still a bit of a nutcase, but he's quite the nutty genius, I would say so.
Number 3, what's your favorite online tool for building Daisy?
Favorite online tool? These days it's like SaaS metrics. So we've been building financial SaaS metrics. I found this tool from a VC that was free. It was like a spreadsheet tool that you put all your monthly recurring revenue in for 5 years and spits out every SaaS metric known to mankind. So I love the fact that it was free. It was just
And what's it? It's SaaSmetrics.com?
Yes. It was SaaS metrics calculator. Yeah, I'll send you I don't remember it off the top of my head. I'll send you the link for it.
Number 4, how many hours of sleep do you get every night?
I'm getting more these days. I sleep 7 hours a night is my average.
That's not bad. In a situation, married, single, kids?
I am married, have 3 kids.
Busy guy. Gary, how old are you?
Me, I'm 55. I just turned 55 on Friday.
Oh, congrats. Hey, we have almost the same birthday. I'm October 3rd.
Oh, right on.
All right, Gary, let's wrap up here with the last question. What is something you wish you knew when you were 20?
Yeah, I wish I knew about business. I would have started the company a decade earlier and been a decade further along, right? I would have wished I'd known more about business finance.
Guys, Daisy Intelligence playing in the retail and insurance AI space, helping those brands make smarter decisions. 25 enterprise customers right now, about $6 million in run rate. And they're about flat year over year due to COVID, but they are burning less. They're only burning $300,000 in net burn per month right now. They also did a raise of additional $5 million, bringing total capital raised to about 20 million bucks. Team is still about the same, call it 55, 60 people, 22 engineers, 3 quota carrying sales reps as they look to continue to scale in both retail and insurance. Gary, thank you for taking us to the top.
Thanks, Nathan.
One more thing before you go. We have a brand new show every Thursday at 1 p.m. Central. It's called Shark Tank for SaaS. We call it Deal or Bust. One founder comes on, 3 hungry buyers, they try and do a deal live, and the founder shares back-end dashboards, their expenses, their revenue, ARPU, CAC, LTV, you name it, they share it. And the buyers try and make a deal live. It is fun to watch every Thursday, 1 p.m. Central. Additionally, remember, these recorded founder interviews go live. We release them here on YouTube every day at 2 p.m. Central. To make sure you don't miss any of that, make sure you click the subscribe button below here on YouTube, the big red button, and then click the little bell notification to make sure you get notifications when we do go live. I wouldn't want you to miss breaking news in the SaaS world, whether it's an acquisition, a big fundraise, a big sale, a big profitability statement, or something else. I don't want you to miss it. Additionally, if you want to take this conversation deeper and further, we have by far the largest private Slack community for B2B SaaS founders. You want to get in there. We've probably talked about your tool if you're running a company or your firm if you're investing. You can go in there and quickly search and see what people are saying. Sign up for that at nathanlatka.com/Slack. In the meantime, I'm hanging out with you here on YouTube. I'll be in the comments for the next 30 minutes. Feel free to let me know what you thought about this episode. And if you enjoyed it, click the thumbs up. We get a lot of haters that are mad at how aggressive I am on these shows, but I do it so that we can all learn. We have to counter those people. We got to push them away. Click the thumbs up below to counter them and know that I appreciate your guys' support. All right, I'll be in the comments. See ya.